Hi friends, welcome to Adda 24/7. We are in the BFM Sankalpa series for important theory and objective questions. Okay, and we are covering important definitions today. Of which chapter? Risk regulations in banking business. So, those who are in the paid class, okay, it is useful for them also, and those who are watching on YouTube, for you also it's very useful. And kindly note, remember, join the paid classes ASAP, because here I'm taking the important definitions over here, but in the classes we have a lot of time. Okay, I'll be taking various numericals, various other theory parts also. So that's why join the paid classes, everyone. The numbers are given over here at the bottom. You are seeing these numbers, right? So call on that number and join it. Chalo, move on. So those who are in the paid class, kindly note, these are the important definitions which you should follow from module B. Okay, uncertainty. What is uncertainty? Under high uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means, like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk, because there is a huge credit risk, because there was huge NPAs during that COVID situation, and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see, the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So, adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have Civil over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata's or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is the difficulty to select a healthy company from the riskier company? It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at a CIB level, it is, what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So these are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether the loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing the difficulty in paying the normal rate of interest also. Okay, or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations. Means my employee errors or my system failure or my region failure, area failure. Area means what? There's a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear, simple. Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you a question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it mutual fund? So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk, that is important. Now if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero. Okay, but if I invest in mutual fund, there is the risk involved in it. So this risk factor I'll have to consider using my this other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay, suppose if you are buying Reliance right now, Reliance share. Okay, you are buying a Reliance share at, let's say, 2500, expecting it to go up. Okay, but if it goes down, then to cover this downside potential or downside risk, what do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost, because put option doesn't come for free. So this will carry the cost. So this is known as the risk, amount of risk, and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk to cover my risk. Okay. So this is for to cover the downside. I'll buy a put, and this put will cost me something, and this will be known as my risk capital, which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So all these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series right now. What are you watching right now? Free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay, risk adjusted return on capital, RAROC. What is RAROC? Have you heard this term RAROC? Type yes in the comment section. Have you heard this term before? RAROC. Type yes in the comment section or no, whatever, yes or no. Fed is? Yes, I've seen many of them. Yes, 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 yes. Okay. So risk adjusted, we have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here. It does this by accounting for any expected losses and income generated from the capital, with the assumption that the riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, REROC. So same as this earlier, we have seen one earlier definition just now. Similar to this. Higher the risk, higher will be, I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So it does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment, okay. Same example. Suppose if I am investing in FD or in mutual fund, so definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So, what do you mean by this? Here, managing the impact of the risk by analyzing, forecasting, and making predictions based on the historical trends. Analyzing, forecasting, and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. Here, this is called as long position. Long means, suppose if I buy a Reliance share, Reliance, okay, at 2500, expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the this derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk. And this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only, okay? Short-term liabilities exceed the short-term assets. Means suppose if my loan, liabilities mean deposits. If my bank's deposits are much more than my assets or my loans, then I'll definitely face the problem of liquidity. Means I'll be facing the problem of this interest rate risk, because the interest going out will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light on its liquidity. So immediately if there is a maturity mismatch, it will be shown in the company's balance sheet. Why? Because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I am having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, also the durations of the loans and the deposits need to be matched. Duration. Okay, that's what the maturity is says. Suppose if I am having a loan or if I take a deposit of, let's say, deposit, okay, if I take a deposit of, let's say, 1 year, of, let's say, 1 lakh, okay, and I have to give a loan against this. So the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's the best. So 1 year, it should be, the maturity should match of deposit and loans. Okay. Market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand this word. See this. It means that if Reliance share, let's take Reliance only. I take Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share and this Reliance share now, let's say, is priced at 2500. Okay, let's say 2500. And now what happens? This Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay. So that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay, that is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer everyone. 2500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then, yeah, 25 crores. Yeah, it will be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material, plus live classes, ebooks, tests, whatever we need for clearing JIB and CIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIB also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to, let's say, 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. Indicates how much the investor stands to lose, how much this investor will lose if this downside potential, means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide the guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See this, guaranteed clearing over here means it is called a settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay? You sell, let's say, shares to anyone, shares, okay? So this other person, Mr. X should give you rupees, right? Rupees, because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part, provides a guaranteed clearing and settlement function for transactions in money, government securities, forex, and derivatives market, right? So CCIL is okay. Tell me one more thing. This shares example which I gave you, does it take care? Does CCIL take care of the shares over here? Does CCIL take care of the risk of the shares, settlement risk of the shares? No. Then who takes care of the settlement risk of the shares which you buy and sell? Type fast in the comment section. Who takes care of the settlement risk of the shares which you buy and sell? Yeah, who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange, and derivatives market. 4 clear. Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay? Yeah. Like that, there are some things which money can't buy. For everything else, there is MasterCard. That was ad. Remember anyone? Now gone, isn't it? MasterCard was having an ad a few years back that there are some things which money can buy, and for everything else, there is MasterCard. Similarly, over here, only share settlement risk is taken by NSE and BSE. For everything else, there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise-wide risk measurement or risk assessment. Enterprise-wise means what? Enterprise-wide means total related to enterprise. Complete company-wise. EWRA or M you can call it, assesses the risk of anti-money laundering, counter-terrorist financing, means AML and CTF, and sanctions. In addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay. So money laundering, AML, counter-terrorist financing, okay, means terrorist financing. Okay. Then second is counter-proliferation financing. Okay. This is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this, even bribery and corruption is part of this enterprise-wise risk, because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all the inclusive elements of EWRA or EWRM, right? Remember, whenever you are talking of enterprise-wide risk measurement, it means you are talking of the whole company, not of a specific section. Okay. Now, before everyone, I would suggest kindly, I told you just now, join the Adda 24/7 officers Adda 24/7 channel. How to join it? Suppose if you have to join on this Telegram, okay, scan this blue QR code. Pause this video and scan this blue QR code. If you have to join this YouTube channel, scan this right side QR code, this one, okay, this one. If you have to join the Instagram channel, so scan this blue QR code, this one, okay, and you can join it. See, there are many benefits available for this, okay. So definitely I would suggest join. Everyone should join this because this is very useful to you. Remember, we give various questions, various recordings plus tests are available on these channels for free also. It's not only paid. Many of them are free also. Hi friends, welcome to Adda 24/7. We are in a Sankalpa series for BFM. And today we'll be covering module C and D, objective questions, treasury, very important one. See, up till now we have covered module A, module B. Now we are covering module C. Okay. So we'll be covering it regularly. I generally we change it regularly so that the entire portion is covered. So that's why watch it at the same time on the same channel every day. Okay. So let's start without wasting the time. Very difficult ones. Questions are difficult ones. Yesterday I had given you one homework. Okay. How many of you have solved this? This I had given you as a homework. Which of the following? This was yesterday's homework. Yesterday's. I'll write it over here. Yesterday's. Okay. This was yesterday's homework. So which one? What was it? Which of the following statements is correct regarding the yield curve risk? Yield curve. Okay. A bank needs to evaluate the movement in yield curves and impact on the curve on the portfolio value and the income. So bank needs to evaluate the movement in the yield curves. What do you mean by yield curve first? Yield curve means what is the yield I am getting? What do you mean by yield I am getting? What is meant by yield? Yield means returns versus my investment. Keep it very simple. Returns versus my investment. So when I plot this various yields for various maturities, these are time, this is time. For various maturities, when I plot, I get this curve, and this curve is known as yield curve. Okay. So let's say for a bond, okay, bond of let's say AAA rating of various maturities, 3 months to 10 years. Suppose if I plot these bonds and the yield of these bonds, okay. So this will give me this is yield over here, yield. This on y-axis it is yield and on x-axis it is time. So if I go on plotting the yields of various bonds from 3 months to 10 years of the same rating, this is very important. Then the curve which I get is known as the yield curve. So what is this yield curve risk? If it goes down, then what? If it goes up, then what? If it goes curved, then what? So a bank needs to evaluate the movement in the yield curves and impact on the curve of the curve on the portfolio and the income. So obviously bank needs to check this again, because as the yield curve changes, so the bank's income and earning also changes, profit and loss also changes. If the liability is raised through 364-day T-bill and is used to fund an asset of 91-day T-bills, it will lead to yield curve risk. So liability is raised. Liability means I am raising a liability means what? Basically, and used to fund an asset means I am funding an asset. If I take a deposit of let's say 364 days and give a loan of 91 days, then will I be facing a yield curve risk? I may be, because once this 91 days loans matures, again I need to refresh this loan. Again I need to give it to someone else. So will I be able to give it at the same rate? Because this liability is fixed at 364 days, because the rate of interest is fixed for the liability, but this is changing. So I'll be definitely faced with the yield curve risk. So answer is C, both A and B. This was yesterday's homework. Let's start with today's part. The features of net interest position of the risk are net interest position. What are the features of this? When there are more earning assets than paying liabilities, the interest rate may arise. Interest rate may arise if the market interest rate adjusts downwards. Again, means interest rate risk, I feel, yeah. Risk, interest rate risk may arise if the market interest rate moves downwards. Now, what is this? When there are more earnings than this, so assets are more than liabilities, okay? Then what happens if the interest rate risk may arise if the market interest rate goes down, moves down. So if there are more assets than liabilities, what does it mean? I'm having more earning, right? My income is more because assets are more. So in that case, if the interest rate goes down, what happens? My earning will reduce. My surplus earning will reduce. So that's why I may be faced with the interest rate risk. So answer is A, correct. What about B? It may result in reduction of net interest income. So that is also true. It may result in reduction of NII. Right? What is the difference between NII and NIM? NII means what? Net interest income. Okay, and NIM. What is the difference between these two? NIM equals to NII upon earning assets, you call it. Actually, you can write it assets also, but it's actually earning assets, not NPA ones. Okay. So this is NIM, and NII means net interest income, difference between your liabilities and asset products. Okay. That interest earning. It will have impact on the economic value of the bank's assets, right? So that is also true. So C is also true. So the answer is D, all of them, isn't it? How many of you got this correct? Type in the comment section. If you got this here, be true to yourself, because in exam I won't be there. It's you who will be answering it. So be true to yourself. How many of you got this correct? D1. Type yes. Correct. Got it? So D. Which of the following are not the features of the price risk? Not the features. And price risk. Price means what? Price of the bond goes up or down. That is basically the meaning. So here, always remember one thing. Interest rate, I'll call it rate. Okay. Interest rate risk is always related to price risk. Both of them go hand in hand. Price risk. Okay. Because the logic over here is, if the interest rate goes up, repo rate, let's say, if the repo rate goes up, the price of the bond will go down. Price of the bond, okay, it always goes down. So it will go down. So that's why they go hand in hand. Interest up, price down. Interest down, price up. So which of the following is not the feature of the price risk? When the assets are sold after their maturity, it may result in price risk. So assets are sold after their maturities, okay. So it may result in price risk. Is it so? When assets are being sold after their maturities, okay, I'm holding those maturities with me. So it may result in price, means the price may go up or down. Is it so? It will never, because after the maturity means what? Whatever is the final amount, I've got it over there. Now, when do I take it? That's a separate aspect altogether. Up to the maturity, only the price risk is there. This is known as operations risk. This is the part of operations risk. If you hold the bonds after the maturity also, means your operation team is not working properly. So this is when the assets are sold after the maturity, it may result in price risk. So not a feature. So this is, we want false one, and this is false one. Okay, so this is true. What about the second one? The price risk is closely associated with banks' trading volume. Price risk is associated with banks' trading volume. That is true, but okay, because the more the trading volume, more will I have the price risk. Banks may create such trading investments out of short-term movements in the interest rates. So that is also true. I can create investments by the short-term movement. So this is true, but I want what? False. So only A is the answer. When assets are sold after the maturity, it may result in the price risk. Okay, I'll clear this board over here. Okay, so that you can watch it freely. So this answer is A over here. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CIB, we get it over here. What do you require for JIB and CIB clearing? 3 things only. Only 3 things. One is ebooks, means books basically. Second is test to check your knowledge. And third is classes. So all of them are over here. Okay, download it right now. Which of the following statements are not correct? Here, always focus on the question. Do they want correct or not correct, true or false, whatever. Okay. So this is, they want false. Okay. Now focus on false. The bond prices and the yields are directly related. Directly. I just now told you in that second question only, right? That bond prices and yields are inversely related. Okay, so this is false. So you have got the answer. Is there any answer? All of the above over here? No. So others are not true at all. Move this, take this and move on. But let's see the other one, because now we are in the study session. In the exam, don't waste your time. Immediately move on. Okay. Market risk may apply for pricing risk for the assets held in the trading book. So market risk may apply for pricing risk for the assets held in the trading book. So that is true. There are two books in the banking. Always remember, trading and second book is what? Banking book. Here the assets or the bonds are held over here for up to the maturity. This is for statutory purposes, CRR, SLR, and this is for proprietary, means buying and selling, earning profit. So that is true. So that's why this is not the answer. We want a false one. The market risk may also apply in foreign currency risk. So obviously, market risk means what? Which is not in your hands. What is the meaning of market risk? That risk which is not in your hands, right? Like Russia-Ukraine war, COVID, is it in your hands? Nothing. RBI changing the repo rates, it's not in your hands. So that's why market risk may also apply to foreign currency risk. So that is also true. So the answer is only A. Okay, clear, everyone? Everyone type yes in the comment section if you have understood up till now. Type yes in the comment section if you have understood up till now. Type yes, everyone. Let me see the comments. Yeah. Fast. Got it? Clear? Concepts are clear? Move on. Will you be able to answer in the exam? If it is asked, will you be able to answer it in the exam? Without remembering. So don't mug up. You need to understand this. Because mugging up is not possible in BFM at all. Not at all possible. Because the subject is so huge. And there are so many possibilities, so many numericals, so many case studies over here. Variety of questions are there. That's why I would suggest join this Sankalpa batch. Okay, I'll come to this later. I'll show you how to join it. We are covering all the numericals, objective questions, case studies, everything is covered. Okay. What is not a forex risk here? That's why they ask you these negative questions. Not. So we want not. False again. False. A risk may arise due to favorable exchange rate movements in the forex. It's called as forex risk. Favorable means I buy dollar for, let's say, 75 rupees. Okay. And now the dollar rate is 85 rupees. So is this a risk to me? I have brought it. See, I have purchased it. I have bought it at this rate. And now the rate is 85. Is it good for me? It is good for me, isn't it? So this is not a risk. This is false. And this is what I want. See, first only you got this answer A. But what about this? Now there is the option of all of these also. So these and these can also be false. This forex risk occurs on account of open position in spot or forward contracts. So this forex risk arises because of open position in the spot. Open position means what? Day end position. Right? Open cash or day end cash, volt cash, what we say. In our bank, we have volt cash. Same logic, volt position, day end position. So this will definitely arise because of this. So this is true. So obviously now don't even check this third answer, right? In exam, don't check it because you know this is true. So all of them can't be the answer. So A is the answer. Now for just checking this, as we are in the study mode, that's why it is applicable to individual foreign currency. That is also true. Individual foreign currency means same logic. I brought dollar at 75 rupees and now it is 70. Then it is applicable, right? So this is true, right? Everyone subscribe to Officers Adda 24/7 YouTube channel. Here, in this channel, you will be getting the free YouTube series. Okay. Plus, we are having Instagram channels. Free YouTube series on all the subjects. We are having Instagram channels, LinkedIn channels. Join them ASAP. Okay. I'll show you how to join them. These features of the these are the features of the basis risk. Basis risk means what? What is meant by basis risk? The rate of interest of liabilities and assets, means deposits and this loans, changes differently in different magnitudes. ROI changes differently, means the rate of interest of deposit changes by 2% and rate of interest of loan changes by only 1%. So that is known as the basis risk. When the interest rates of different assets, liabilities and off-balance sheet items change in different magnitudes, it is called as basis risk. What is it? Now you tell me. Is A true? A correct answer? Yes? Type yes if you feel A is a correct answer. Interest rates of different assets, liabilities and all these. Okay? So A is correct. Okay? But there is the option called as all of these. So that we'll have to check now. All of these means I'll have to check B and C also. When the interest rate of assets rises in different magnitudes as compared to the interest rate in the corresponding liability, which may result in variation in net interest income, it would be known as basis risk. So again the same, wording is different only, logic is same. Assets interest rate rises with in different magnitude than that of the liability. That's it. So B is also true. So once you get A and B true, immediately you jump to D. Okay, because obviously C will be true, isn't it? So the basis risk is quite visible in volatile interest rate scenario. Obviously, volatile means high changing interest rates, very high changing. Okay. Right now in US, the same thing is happening. If you check USA, they are facing the same crisis now, volatile interest rates. Okay. Which of the following is not correct regarding the basis risk? Not. So again, we want what? False. Always immediately mark this. You want false answer. When the variation in the market interest rate affects net interest income, income to expand it, it will be unfavorable basis shift. So variation in the interest rate affects the net interest income to expand it. It will have unfavorable. So net interest income is expanded. So it will have unfavorable. Expanded means what? My net interest income is increased. So if it is increased, then is it unfavorable for me? So that is false, obviously, isn't it? So this is gone. So A is the only answer. Don't even look at B and C because all of these is not the option. So A is the only answer. But then also, today we'll do it. In exam, don't do it. Exam, just move on. Okay. When the interest rate movement causes net interest income to contract, the basis would be moved against the bank. So obviously, net interest income to contract. Contract means it is against me, in unfavorable to me, isn't it? So that's why B is true. So this is not the answer. We want false. This is true. Okay? True. The loan portfolio is funded out of a composite liability portfolio. This causes higher degree of basis risk. So here, composite liability. Composite means various liabilities. Liabilities can be saving, can be current, can be FD. So if I am having the composite liabilities, this will cause a higher degree of risk to me. Obviously, because all will change in different magnitudes. So that is true. We want a false one. Okay. Now I told you how to join this Officers Adda 24/7 YouTube channel. Here on LinkedIn, this is for LinkedIn. Okay, LinkedIn. No, sorry, not LinkedIn. That's this Telegram channel. LinkedIn I generally use. Okay, Telegram channel. So this blue one is for Telegram channel. This black one is for your YouTube YT. Okay, and this next one is for Instagram. So join all of these. Insta. Okay, join all of these. Scan this. Just scan this and you'll get it. Okay. Because as I told you, we cover all the important YT series, all the important questions, important tests on these channels. Immediately join it. Okay. The features of embedded option risk are, embedded option means what? What is embedded option risk? It means anyone can repay my loan. Suppose if I have given a loan to somebody, term loan or CC. Customer comes tomorrow with all the money and says, okay, tata, bye bye, take your loan back. Deposit. Customer comes tomorrow with the slip, the deposit slip or that deposit receipt and tells me, tata, bye bye, take this receipt, give me my money. So this is embedded option risk, where the customer can withdraw their deposit funds anytime or repay their loans anytime. So which are the features of embedded option risk? When the bank is exposed to the risk due to prepayment, see here, prepayment of loan or premature withdrawal of term deposit, it is called as embedded option risk. Just now I told you, same, right? So A is the answer, but there is an option of all of these also. Check this now. This can be experienced in volatile situations. Volatile means too much changing rate of interest. This generally happens in volatile. Okay, so B is also the answer. So obviously now D will be the answer. C is true. The greater the magnitude of the changes in the interest rate, the higher will be the embedded option risk. So more the changes in the interest rates, more will be the embedded option risk. So that is correct. Okay. These things do happen in volatile situations, because what happens if the customer is having a loan with you Okay. And now due to volatility, the rate of interest of the loan changes drastically. Right now you are giving the loan at, let's say, 8% to this customer. Okay. And due to the volatile situation, your bank increases the rate to 10%. So good customers will run away from you. Run away. They won't stay with you. Okay. Why? Because 8 to 10, whose 2% extra is a huge amount for larger loans. Okay. So this is embedded option. Which of the following is not correct regarding the embedded option? We want a false one now. Okay. This results in rejected reduction of the projected cash flow. So not correct, embedded option, reduction in the projected cash flow. Yeah, that is true. Okay. So we want a false one. Huh? It does not affect the bank's income. What is this? Does not affect. It is false. It does affect. So B is the right answer. Don't even look at C and D now because there's no option of all of these. If you want, I'll just go through it. Here, the risk may arise due to premature exercise of call put option. So that is true. What is call put option? Call put means the customer has a right to repay the loan or withdraw the cash. Okay, that is call put option. And D1, the withdrawal of deposit before maturity date would also cause embedded option risk before maturity, isn't it? Just now we saw that. So that is also true. So that's why I said in the exam, don't even look at C and D. Immediately move on. Okay. Now one for your home. 7. We are in the BFM Sankalpa series, and in this series, we are covering important theory and objective questions. And today's topic is technology in international banking. Here, the same topic is going on in the paid class also. Everyone, kindly note. Same topic is going on in the paid class. So, if those who are in the paid class, they can follow this series also for the important definitions. Okay. So you guys, those who are watching on YouTube, kindly join the paid classes because in details it is covered. It is covered over there. Okay. So let's start. See here. We'll be doing today the important definitions which are asked in the exam. Very important definitions. Okay. Because these definitions I have seen it in so many exams. Okay. So fintech. First definition. Fintech means what? Fintech refers to the synergy between the finance and the technology. See here, sometimes they call it fintech, and there is a separate word called as techfin also. Techfin. Okay. So techfin and fintech, these are not same words. Fintech means first finance and then technology. Finance plus technology. So basically this company is in finance and then it is using technology. But techfin over here means the company is in technology. Understand the difference? Technology and then it is doing finance. Okay. Now you'll say, sir, what is the difference? Only words are the different over here. See, the difference is like this. Suppose SBI. SBI will fall in fintech. SBI, HDFC Bank, all are banks. They are fintech. They are first finance, then technology. Techfin means what? Google. Google will fall in Techfin because it is first technology and then it is giving loans. Phone Pay. First it is technology, then it is giving loans. Google, Phone Pay. Okay. So these are all the Techfin companies. Understand the difference? There is a slight difference in the words, but huge difference in the overall companies. Okay. So finance plus technology. Fintech refers to synergy between finance and technology. Okay. Second one, regtech. Now what is this regtech? See the words, you can break it up over here. Reg means regulatory. Reg plus tech. So reg refers to regulatory. Technology in regulatory aspects, focusing on automation of the compliance processes for the banks, right? So automation of the compliance. What do you mean by automation of the compliance? What is this? Okay. See here, I'll give you simple reason, simple logic behind this. Compliance. Let's talk of simple terms like large cash transaction report. Okay. Large cash transaction report means any transaction about 10 lakhs of cash, right? So in large cash transaction report, why has a bank or the employee to report it? As you are having the technology over here, right? So immediately it should be reported, it should catch which is the large cash transaction report and give it, isn't it? So that is known as automation. Similarly, for this bill of entry also in trade finance. Now, those who have covered this batch, those who are in the batch, they'll understand the SDF form and BF form. BEF. I told you BEF entry is now BEF report is now removed, right? Why? Because of this automation in the technology. Means bill of entry, whatever is coming in, why should it be reported separately now? Once it's in the customs office, you get it through their system, it is automatically reported to RBI, isn't it? So automation means reducing or removing the manual work in the compliance part at least. Okay, because compliance, always the problem in compliance is if there is a human intervention, always it faces the problem. There is some error, some manual error. So if it is done by machinery, nothing as such. What has happened in clearing now, isn't it? What is clearing? Clearing is gone now. It's all automation now, isn't it? AI, artificial intelligence. It refers to the simulation of human intelligence in machines that are programmed to think like human beings and mimic their actions. Understand this, programmed to think like human beings. You'll say, sir, how can a machine replace a human being? Of course, it can't. No machine can replace a human being. But if you look at your banking activities, what are you doing in the banking? Tell me. If you look at the banking activities, just tell me one answer. Everyone give me the answer in the comment section. Give me one answer. How much part of your job is repetitive in nature? Repetitive means daily you are doing the same job. Same job, same desk, everything. So how much part of your job is repetitive? I'll give you two options. One is almost 90% of your job, and second is 10% of your job is repetitive. Every time it's a new job. Right? Give it in the comment section. Everyone write in the comment section. How much part of your job is repetitive? Correct. Almost 90% of your job is repetitive. 90%. Because daily you can't have new things, isn't it? Will you have daily new challenges? No. We'll have repetitive job almost every day. Some days some new thing comes. Okay, so whatever is repetitive, that can be done by the AI. Here, simple thing is, whatever is repetitive can be handled by the machines. It's that simple. Okay, and mimic their actions. Mimic means rehearse, means do it again. Okay, so AI basically, whatever you are seeing right now, chatbots. What are chatbots? Chatbots we see everywhere nowadays. You go to any site and you see, may I help you? Then you type in that message and then you get chatbots. So now chatbots have gone to the higher level. Now we have something called as chat GPT. So chat GPT, what do you get over there in chat GPT? You get various other things also. Not only this replies, but also you get the this artificial intelligence helps you to find the answers to the repetitive questions of the customers. Okay. Next is machine learning. Machine learning refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history, behavioral pattern, advisory services, etc., thereby enhancing the customer experiences with the banks. Now, what do you mean by machine learning? Here, machine learning is known as learning by the machine. It refers to the algorithm by analyzing millions of data sets to provide inputs to the banks. So learning by the machine means this is called as, there's a word in machine learning that is called as cognitive. This word you will hear many times. Okay, cognitive, TIVE. Okay, cognitive means continuous learning. It refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history. So whatever are the customer transactions, whatever are the behavioral patterns of that customer, advisory services. So all these things, basically behavior patterns. Here, if you see the behavior pattern of any customer in the, at least in the financial field, by that you can definitely govern which products are to be sold correctly to that customer. Okay, thereby enhancing the customer's experience with the banks. So if the customer receives proper treatment or proper advice as per the customer's requirement, then definitely what happens? In that case, the customer will stick more to your bank rather than giving some vague. Means, for example, I'll give you. Suppose if any customer is requiring, let's say, loan. Okay, he is facing some financial problem, and you are trying to pitch to that customer insurance or mutual fund. These are investment products. So will that customer come for this mutual fund or investment with you? No. That customer requires a loan, so you have to pitch in the loans. How will you know whether that customer requires a loan or not? Through his or her behavior pattern. Okay? Behavior pattern means if that customer has asked for the loans, or if there is huge cash withdrawal or transfers from that account. So that is all captured under AI now and machine learning. Okay? So it refers to the usage of algorithm. Remember this word algorithm. What is algorithm? Algorithm is a set of computer programs. Okay, done. Computer programs. Okay, which make this machine think on the repetitive jobs. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates on JIB and CAIIB. Number one. Number two, you will be getting all the free YouTube series on JIB and CAIIB. So subscribe to it, click on the bell icon, click on the like button, click on the share button, share it with your friends, isn't it? What is big data and data analytics? Here, big data deals with the data sets that are too large or complex to be dealt with the traditional data processing application software. Now, what do you mean by this? Here, many times in your computer itself, we see our own computer, your home PC it might be, or in your bank PC also. The computer operator or the admin guy, systems administration, when that person checks your computer and he or she says your data is too much loaded, your server or your CPU does not support it, your laptop doesn't support it, memory is too much gone. What is that? What is that person saying actually? That person is talking of big data. See here, every machine has its own capacity. Okay. Suppose if I want a huge data analysis of entire banking industry, I can't keep it on a single PC or even a simple server. For that, huge servers are required, right? So big data deals with data sets that are too large or complex to be dealt with by traditional data processing application software. Okay. Big data is advantageous where volume, variety, and velocity of the data is huge. Now understand the three words, very important. Okay, volume, variety, and velocity. Velocity means speed. We require huge speed. Okay, science graduates might understand this. Okay, velocity is speed. So volume, variety, and speed. All the three things are required and they are huge. Volume is huge means if you consider SBI, what will be the volume? If you consider your own bank, forget SBI, your own bank, what will be the volume? Per day volume. It will be huge. So a server needs to cope up with such big volume. Variety. There are thousands of transactions, variety of transactions. So all the variety needs to be captured in your system. Similarly, velocity, speed. If you imagine in the bank, if when you are using your system, and if it takes around 1 minute to answer, even 1 minute is a long time in front of that customer. Waiting for 1 minute is a huge time. Okay, so that's why it needs to be at a huge speed. That's why we have all these 4G, 5G, 6G, all these things. Okay, got it? Data privacy and digital privacy. Now, what is this data privacy? See this. These words many of you might be knowing now by now, isn't it? Privacy means secrecy, right? Digital privacy, same. Okay, digital and data both mean one and the same thing. So data privacy or digital privacy refers to the protection of an individual's information that is used or created while using the internet on the computer or a personal device. So what do you mean by this? Refers to the protection of individual's information. Okay. Now what all information can the individual have? Individual will be having various informations like name, mobile number, that is common thing, address, right? But like graduate, what is your education level? Then what is your family size? Are you holding any assets, car or anything? Okay, plus have you taken any loans? So these are all the individual information. Remember, individual information can be of two types. Always remember, it will be of two types. One is static, and second is dynamic. Okay, dynamic. Static means what? Which does not change. Means what? Your name, generally your name, your address or your Aadhaar number, these don't change. PAN number, they don't change at all. What is dynamic? Are you holding a car? Are you holding some loans? These are all dynamic things, right? Education level is static generally, because once you are educated, you won't change your education. Yeah, generally I'm talking, huh? Somebody can do the changes in that also, okay? So static and dynamic means that, okay, refers to the protection of individuals' information that is used or created while using the internet. While using the internet means whenever I fill up any form for Google, or if I fill up any form for your bank, online form. So if that form, it gives my all the details and that is breached, that is shared by your bank, let's say, with someone else. So what is that? That is affecting my privacy, isn't it? While using the internet on a computer or a personal device. Personal device means anything related to computer or mobile also. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing the JIB and CIB, we'll be getting it over here. So that's why download it right now. Okay. Data breach. What is data breach? Sure. Just now we talked about data privacy. Importantly, remember, these are all the important questions, and you'll get some of them, at least two or three of them, two at least out of this series, whatever we are talking right now. Today's session, you'll get at least two 1-mark questions in your exam. Okay. So now you know, everyone among in CIB knows the difference between 1 mark, the importance of 1 mark. The difference is 49 and 50, right? 49, 50 is cleared and 49 is not cleared, isn't it? So data breach. Data breach refers to the security incident in which malicious insider or external attackers gain unauthorized access to the confidential data or the sensitive information, such as medical records, financial information, or personally identifiable information. Now, data breach means what? Just now we discussed about the static and dynamic, right? Dynamic means what here? This security, generally this dynamic information is very sensitive, because static information generally everyone knows. Where are you staying? What are you doing? Okay, all these things which don't change. This generally everyone knows. What is important is dynamic, and all the companies want this dynamic data, because it is changing. It is changing, and what happens? Your habits are changing accordingly. So data breach refers to security incident in which the malicious insider. What do you mean by malicious insider? Insider means that person working in the bank itself. That person compromises the data and gives it to some other external company or external attackers. External attackers means what? These are all those attackers, these cyber attacks. Okay. So these cyber attackers or these insiders gain unauthorized access. Unauthorized means even the banker can get unauthorized access. Suppose if you are in the branch, do you have the access to the head office data or sensitive data, balance sheet and everything? Do you have access to that? No. That is, if you have access, you are in the branch, you have to get access only to your part. So that is known as unauthorized data. If you get information about something else which is not required by you, so that is known as unauthorized data. Okay. So unauthorized access to the confidential data or the sensitive information, such as medical reports, financial information, or personally identifiable information. So medical reports, sure, that's what I said. These all things are dynamic. If you check this, these are all dynamic, right? Dynamic means what? They go on changing. Dynamic, right? Medical reports, they go on changing. Financial information changes. Personally identifiable information, right? So these are all the changing things. Okay. So mainly the access to this is required by the companies so that they can sell the various products to you. Okay. P2P lending means a financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. P2B means peer to peer. This is known as peer to peer, or in simple you can call it peer to. It's two, peer. In simple way, peer. You can call it peer, people to people. P2P lending is an important aspect coming. This P2P lending will change the entire banking scenario. Remember this. So, financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. So, P2P lending will change the entire. See, right now, what is happening? Why are people depositing money in the banks? Because they don't know who is to take, who wants the loan, and they don't have the confidence on that person who will get the loan. Right? Suppose if I get somebody, tomorrow you require the loan. Okay, you require, let's say, 1 lakh rupees, and I am having excess 1 lakh rupees. So why should I deposit it in the bank and then that bank gives you the loan? I'll directly give you. So that is known as P2P lending. So there are certain problems in that, but those can be tackled nowadays. There is account aggregator system that can definitely tackle it. So it means secured and unsecured personal loan, the person who wants it with the investor, connecting this buyer and seller. It's that simple. Cloud computing, it refers to the delivery of computing services including servers, storage, databases, networking, software, analytics, and intelligence over the internet to offer faster innovation, flexible resources, and economies of scale. Cloud computing, you must definitely know this definition because this is the important part of technology in international banking. Computing services including servers, blah blah blah, storages, databases, software, analytics over the internet. Now remember, over the internet means this is the server will not be a physical server, it will be in the cloud. You might have seen many of these, right? Many of the companies have come like that. What GoDaddy, right? There's a company called as GoDaddy. Check that, okay? That is giving online servers. Okay, there is many of them are there. One I know because I've used that data. Servers, storage, databases, networking, software, analytics, everything on the internet. There is no physical existence. To offer faster innovation, flexible resources, and economies of scale, right? Clear? So everything is on internet over here. There is no physical thing. Okay. Now, to join, as I told you, join this Adda 24/7 download this app or join the YouTube channel. But how to join it? See, just scan this QR code right now. This blue QR code is for Telegram channel, official Telegram channel. Scan it. For all, you might be in JIB, you might be in CAIIB or any other bank promotion. Similarly, YouTube. Scan this right side QR code, this one, okay? This QR code. Then if you want to join this Instagram, okay, join this QR Instagram. Okay, scan this QR code and you'll join this Instagram channel. Remember, there are many fake channels available. Fake channels. So we need not join those. Okay, because here in the world there are always copycats, right? So that's why join it immediately. DigiBank, an entire bank squeezed to fit in your smartphone. DigiBank, there is no physical existence of that bank. Remember, there is no physical existence of that bank. There is only one head office. And there are no branches. DBS has started DBS. They have started DigiBank. Many of the Indian banks have also started DigiBank. No physical branch, only head office. That's it. Regulatory sandbox. This is a new definition. It refers to an environment where it allows the regulator, the innovators, and the financial service providers and the customers as final users to conduct field tests to collect evidence on the benefits and risk of the new financial products. So, where regulator, innovator, and the financial service providers. Now look at this. All these elements. These are all the we call the stakeholders, regulator, innovator, financial service provider, customers as a final user to conduct field test to collect evidence. So field test is collected. Important part over here is field test. Okay, conduct field test to collect evidence on the benefits and risks of the new financial product. So whenever I am launching a new product, what are the benefits of that? Will it be harmful? Will it suffice my this purpose? So that all evidence is collected using this regulatory sandbox. Okay, understand this word is very important. Conduct field test to collect evidence on the benefits and risk of the new financial products. Robotic process automation. It refers to the process of assigning manual repetitive tasks to robotics instead of humans in order to streamline workflows in financial institutions. So it refers to what? The process of assigning manual repetitive tasks to the robotics here. Assigning repetitive tasks to the robotics instead of human beings. So robotics instead of human being. That is the basic logic behind this robotics process automation. So human beings should not be used for repetitive jobs. Human beings should be used for innovative jobs. Okay. Blockchain technology. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Okay. So blockchain is basically recording information. Recording information. Okay. Yeah. So now guys, the exams are near. Okay. So the exams being near, immediately join the revision batch for CAIIB. Look at this. Go to JIB and CAIIB. I'll always suggest. Good morning, friends. Welcome to Adda 24/7. We are in the Sankalpa series for BFM. In this series, we are covering important theory, objective questions, some numericals, some case studies. So all of the parts we are covering. So today what are we covering? Today we are covering in BFM. Here, this is basically right now the time is for BFM. Okay. So in BFM today we'll be covering Incoterms. What is an Incoterm? I'll tell you. Sure, important part is Incoterms is it is around 5 to 6 marks in your exam for BFM. 5 to 6 marks, remember. That much is the importance. So what is the schedule? Look at the schedule. One is we'll be studying firstly Incoterms, what are the various Incoterms. And second, we will be having the objective questions on the Incoterms. Okay. So firstly, let me discuss this. Now, many of you might be actually knowing the Incoterms, what the meaning of Incoterms, but then also I'll give you. Incoterms means it's a responsibility. Responsibility. Okay. A responsibility between whom? Here, whenever I do any export from here, so in that case, where will the seller give the goods and where will the buyer take the control of those goods? Where will the seller leave the control of the goods and where will the buyer take the control of the goods? This term is known as Incoterms. Means where, suppose, let's say, I'll tell you regarding this Incoterms. Whenever we go to them, you'll understand it better. Suppose, let's take the first Incoterm, Xworks. Okay, what is Xworks? Xworks means what? If this is my factory, okay, let me expand this. Okay, so it becomes easier for you to understand. Let me expand this. See, this Xworks. Suppose if seller says, I will put the goods, manufacture these goods and put it in front of my factory. I won't give you anywhere else. Just in front of my factory, I'll place them, you pay me and take these goods from here. How do you take it? What do you do? That's not my concern. So this is known as Xworks. This is the best Incoterm for any seller. Always. Why? Because here the responsibility of the seller is up to what? Up to the gate of his factory. That's it. From here, everything is on the buyer. Tomorrow, while taking the goods, there is an accident. or if there is some robbery, then seller is not responsible. Seller says, okay, I have given the goods as per my terms and conditions. Now it's your responsibility. So this is known as ex-works, the best Incoterm for the seller. Then comes a bit higher. Now the buyer is in, let's say, USA. Seller is in, let's say, India. Okay. In that case, what will the buyer do? What will the buyer do over here? Now, if you look at it, the buyer over here, see this, I'll take this over here, huh? Or shall I make it smaller so that you understand? Yeah, now it's easy, simple to understand. Okay. Now let's say the buyer is in USA. Then what will the buyer say? Sir, see, coming to a factory and taking it is a difficult part. What I'll do is, you do one thing. You put these goods on the ship, load these goods on the ship, and from here my responsibility will start. So the seller will say, okay. In that case, what will happen? Seller will manufacture these goods, take these goods in the truck from his place or her place, not only his or her place, okay, up to the port, okay. And here the seller will take them up to the port and load these goods into the ship. This is called as loading on this on board. This is known as board. Okay. So the goods will be loaded on the board. Here the responsibility of the seller ends. Once the goods are loaded on the board over here, say this. Once they are loaded over here on the ship, then the responsibility of the seller ends. Okay. Then what happens? If tomorrow something happens to the ship, so this ship gets sunk over here, or there is a robbery, there is some storm, and the ship gets material gets distorted. In that case, the seller is not responsible. Seller's responsibility was only loading on the board of the ship. Now, what is on the board? Again, remember this word you will find it many times. On board, on board, on board. What do you mean by on board? What is the word on board over here? Here. Now, this is a bit. We are going into the ship, right? It's not needed, but then also let me explain you. This top part of the ship is known as deck, D-E-C-K. You saw that Titanic movie? Everyone has seen that Titanic movie? That sea standing here and then that song, right? All that. This is known as deck, this top part. And board means this lower part, board. Always material or goods are always loaded in the ship below. Goods are always loaded on the board. They are never loaded on the deck. Okay, they are never loaded on the deck. So this is on board means the goods are loaded on this below part. Okay, otherwise what will happen? If they are loaded above and people are below, what will happen? They fall down on the people. Logic, isn't it? So that's why they are always loaded on the board below. Okay, so now what happens? Suppose if tomorrow this buyer says that this FOB you have understood? See here, on board. So this is known as FOB, free on board. So the responsibility of the seller is to load it on the board. Now there is one more Incoterm attached to this. Means if the seller says, no, 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 I won't load it on the ship. I will load it, I'll just put it besides the ship. Means wherever you have that place of keeping the goods on that port, there you will see, there I'll put it and there I'll put these goods. So that is known as FAS. Now what do you mean by this besides the ship? All of you have seen the old Hindi movies. Always in last, there is always a fight between the hero and the villain. Now 1980s, 90s, those movies, up to 2000 also. Nowadays everything is gone. Nowadays nobody has that last fight in the movie. There was a concept of last fight in the movie. Everyone remembers? Type yes in the comment section. Have you seen that old Amitabh or anyone's movies? Last fight. That last fight was mainly, many a times, it was on that deck only, on that ship only, port. All those containers, hero jumps. Now also you see it in the South Indian movies, right? Many of the South movies. You'll see the same. the hero jumping from that container, all that containers, that is basically FAS. So next time whenever you see this, you just call it FAS, FAS. Okay. Free alongside ship. This is known as free alongside ship. Okay. So this is FAS, free alongside ship. Got it? Now this is Incoterm FOB, this is FAS. Now next one is CFR and CIF. Look at this, CFR and CIF. CFR means what? Cost and freight. What does it mean? Here it means that the seller will put the goods on the ship, number one, means on the board. Then he'll buy the logistic cost of this ship. Logistic cost means the ticket, you can call it in simple language. The ticket of that ship. That will be borne by the seller. So this is known as CFR. Now when this guy buys the ticket, then what happens? See here, his responsibility, his or her responsibility is only up to buying the ticket. If tomorrow something happens to the ship, again seller says I am not responsible. My responsibility was putting the goods on the board and buying that ticket. Okay, so that is called as CFR. Transport paid, transport. Okay. The next one after that comes CIF, cost, insurance and transport. So what does it mean? Here the seller will buy the ticket also, and also the next thing which he will buy, he or she will buy is insurance. If tomorrow this ship gets sunk, then the insurance company needs to pay. So who will pay the premium of this? So the premium is paid by the seller over here. So in CIF, the premium and the transport cost is borne by the seller. Important, remember. Okay. Why am I focusing more on this FOB, CFR, CIF, FS? Because 95% of the trade in this world, okay, big trade and not smaller trades, oil or all rice exports, anything, 95% of that is done by a ship. It is not done by any truck, it is not done by any this aeroplane, nothing. That's why we must always focus on ship. Okay. Now, important part over here, FOB. This FOB is important because your pre-shipment finance is always given on FOB in India. Pre-shipment finance means packing credit. That is always given on FOB. That's why this FOB is so much important. Okay. Now suppose if I ask you to, suppose if I am having CIF Incoterm. Now answer me, everyone answer me. Suppose if I am having a CIF Incoterm and I have to come to this FOB Incoterm. From CIF I have to come to FOB. How will I come? How will I come to this point from CIF to FOB? How will I come? What will be my method of arriving at this FOB? Here, C means what? Cost. This cost means actually FOB. Understand this. C means this FOB. FOB is what? Free on board. That is the manufacturing cost. So this C means FOB. So if I have to come from CIF to FOB, I have to remove this I and F. Simple. So I'll have to remove this insurance and I'll have to remove this transport. So I'll just subtract this insurance and transport fees, whatever is paid, and I'll come to FOB. Because in exams, many times they give you CIF and then they ask you to find out the FOB. They give all the figures. Insurance also they give, then freight also. You have to just subtract it and you come to FOB. Okay. But also remember, while giving the pre-shipment finance, we have to subtract the profit also. Never forget the profit, because pre-shipment finance is given for the cost, not for the profit. And post-shipment finance is given on whichever Incoterm is given. No subtraction, nothing. Whatever is given, pay 100% in post-shipment finance. Remember, post-shipment finance, pay 100%. Pre-shipment finance, we finance as per the Incoterms, and that also FOB Incoterm, and that also generally 75%. Got it, everyone? So what are the four main Incoterms related to ship? Related to ship: FAS, FOB, CFR and CI. Okay. Now next one. This is related to ship. Now if I have to transfer the goods, I said 90-95% is done through ship, but that 10% is done through this road and air also. So if I have to transfer the goods through road, then what? So if I have to transfer the goods through road, then the Incoterms used are different. What are these Incoterms? Then we have firstly FCA, free carrier. Now free carrier is same as FOB. Now look at this. Have I written it over here? No. See this. Free carrier is same as FOB. FCA on road is same as FOB on ship. Remember this. Simple. Here also the seller will just load the goods on this truck and that's it. Okay. Similarly, CPT, carriage paid to. Carriage paid to. Okay. This carriage paid to is same as CFR, cost and freight. CPT and CFR, same. Only CPT is related to road or air also. See here. For airway, you will say road, but what about airways? What about railway? Anything other than ship. These Incoterms are used. FCA, CPD, CIP, DAP. Anything other than ship. Okay. Sometimes even in air, even in this road, everywhere, there also these Incoterms are used. There also means in air shipment also you might find something FOB. So whenever we say FOB in air, it means we are talking of FCA. Okay. So CFR got it. Next one is CIP, cost insurance paid. Now what is this? Logically, tell me. This will be equal to what? Type in the comment section. Type in the comment section. This will be equal to what? Everyone. This will be equal to, yes, CIP will be equal to CIF. CIF, cost insurance and paid. Because here also cost and this carriage and insurance paid. Okay. So got this point now? Now this is an Incoterm for road. Okay. So now you got these four FAS, FOB, CFR, CIF. FCA, CPT, CIP. Done. X works already done. So how many are closed? 1, 2, 3, 4, 5, 6, 7, 8. Okay. Now 2, 3 are remaining. DAP and DDP. Okay. These are remaining. Remember, they are hardly of any use in your numericals. In numericals, you won't get it anything related to DAP or DDP. Only this is for theory. In DAP means what? What do you mean by this Incoterm DAP? DAP means delivery at place. Delivery at place means what? Wherever this buyer will say, there the seller will have to send the goods. If buyer says, I have a godown there in Chennai, my office is in Mumbai, you send the goods to Chennai godown. So what does it mean? Delivery at place. Send it to Chennai godown, even though the office is in Mumbai. Okay. So in DAP, remember delivery at place. Here it is decided who will pay the customs duty at the export side, who will pay the customs duty at the import side. Both the things are decided. Okay. So and DDP, delivery duty paid. This is the best Incoterm for the buyer. Why? Because in DDP, now look at this. This DAP and DDP, they are applicable to both ship as well as road and rail or air or anything. Okay. Now DDP is applicable. DDP means what? Delivery duty paid. It is the best Incoterm for the buyer. Why? Because here every responsibility is on the seller. Paying the customs duty at the export side, paying the customs duty at the import side for year. Then bringing the goods up to whatever place this buyer wants. So that is known as DDP. So these are the 10 Incoterms which are used basically in any export or import trade. Okay. See, this is the example I have given. Suppose if I am having CIF of 1000, insurance is 30, freight is 60. Then my this FOB will be what? 1000 minus 90, 910. Okay. CFR, cost and freight, it is 1000. Insurance is 30. Freight is 60. Then FOB will be what? Now understand this. Here what have I done? I have subtracted only 1000 minus 60. I have not done this subtraction of 30 because it is CFR Incoterm. Cost and freight. Only have to subtract freight over here. So 940. Got it? Always remember while solving any numerical, you have to do this. But you have to do in addition this profit percentage also. Now this is a typical numerical which I have solved. Just for your reference, I'll give you. CIF is given as 1200. Insurance and freight, now combined it is given as 10%. Profit is given as 15%. So suppose if I tell you to arrive at a FOB or pre-shipment finance. Suppose if you have to give the pre-shipment finance in this part, overall this scenario. Okay. So what will you do? CIF is 1200, insurance and freight is 10%, profit is 15%. What will you do? First, what you do, you first find out the 10%. What is the 10%? 1200, right? 1200 minus this 10%. So it is what? 120. Okay. Then again, profit is 15%. Find the profit of 15% from this 1200 itself. So 1200 into 15%, 180. So now subtract this. 1200 minus 180 minus 120. So you get it as 900. So this is FOB value. But from this FOB value, what have you to do? You have to give the finance of 75% only. So from this 900, you'll be paying 75% only. So this is the basic logic of pre-shipment finance. That's why I took this numerical over here. Okay. Now before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing a JIB and CIB. We'll be getting it over here. Okay. So download this immediately. Got it? Okay. Now these are the Incoterms. I have written it over here, theory part. So you can definitely read this. Departure, X-Works, already explained. Main carriage paid, CFR, CIF, CPT, CIP. All these are showed. Main carriage paid Incoterms. Now these two are related to ship. CPT and CIP are related to this, this road and air and everything. Okay. Main carriage paid, unpaid. Unpaid means the carriage is not paid. FCA, FAS, FOB. FCA is related to this what railways or road. FAS and FOB are generally related to ship. Okay. Arrival, DAP and DDP, delivery at place, and this DDP is delivery duty paid. So here arrival means at the importer side. Okay. This is, I have given the responsibility for each of the seller, means it's same thing which I discussed, just it's given in details over here. Details means where the responsibility is for your reading basically. Incoterm, X-Works, FCA, FAS, FOB, all these. Export packaging, who is doing what? Okay. So where is the responsibility? These are the responsibilities. Okay. You can read this, expand this, enhance this video and read this. Okay. Next one. Now before going ahead, everyone join Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates. Now how to join this? Latest updates from IIBF regarding JIB and CIB, and importantly, you will get this, the free YT series, YouTube series. Now how to join these channels? Scan these QR codes. This is for your this Telegram channel. This is for your YouTube, and the next one is for your Instagram. Scan them and join it immediately. We are giving many free YouTube videos over there, ebooks over there, tests over there on these channels. Join all the three. Okay. Now let's come to the questions. Minimum obligation of the seller is represented in which time of the Incoterm? Now this is easy for you. Answer is FOB, X-Works, DDP and DPU. Now which one? The correct answer is X-Works. Correct? X-Works. Okay. FAS and FOB are rules of which kind of transport? Which kind? Any kind of transport, internal, inland waterways and seaport, railways only, and air only. What is this? Now type in the comment section. Let me call this A, B, C, D. A, B, C, and D. Now type the answer. Is it A or B or C or D? FAS and FOB are which type or for which type of this transport? It is B, correct? It is B, isn't it? Next one. There's a Thai company which imports from USA, which is importing from USA for the first time. When this company imports from USA, which Incoterm consignee should propose to the shipper for their benefit? Their means whose benefit? Their benefit. Consignee. Who is the consignee? Consigner and consignee. Consignee means it's always the buyer. Okay. For their means what? Buyer's benefit. Let's talk about this buyer's benefit over here. Buyer. Let me be specific over here. Buyer. For buyer's benefit. So which Incoterm should this buyer propose to the shipper? Shipper means seller, exporter. So should he or she propose this X works or FOB or CFR or FCA? Now, what do you say about this? Now you are having the problem. All of you might be thinking, sir, the best one is DDP for the buyer. But there is no DDP given over here. So the right answer is DDP, but no DDP given. But what is the answer then? See here, we have to choose the best among these. X works means what? It is the best for the seller. FOB means what? Loading on the ship. CFR means what? Cost and freight. And FCA means what? Free carrier. Okay. So FOB and FCA are same. So these are same over here. So which is the best among these? X works, FOB and CFR. Which is the best for the buyer? Which is the best for the buyer over here? Among these three. Among these three it is CFR. Remember, DDP is the best for the buyer in ideal conditions. It might not be ideal conditions every time. Okay. So which is the best for you, that you should agree. Suppose if it is said that benefit for the seller. Suppose if this is for the seller's benefit, then which one is the best? Then it's X works. For the seller, it's always X works, right? Which is this Incoterm? Say this Incoterm. Here the seller is, this is the seller. So seller is putting the goods up to the ship. Okay, up to the ship, loading the goods on the ship, and then the ship is going out. So which is this Incoterm? FOB, X works, CIP, CPT. Type in the comment section. Which is this Incoterm? Which is this? Fast, fast, fast. This is FOB. Okay, free on board. Correct? What is the difference between CFR and CIF? CFR, see this, cost and freight. If CIF means cost, insurance and freight. So CFR, no duty. CIF, shipper pays duty. Is this related to duty? Not at all. Nothing related to duty. CFR, shipper pays cost, means freight. Here consignee pays freight. Now shipper pays freight, and here CIF, consignee pays freight. Shipper means this shipping company. Okay, or in fact the seller. Okay, seller. So shipper pays the cost, freight, and here consignee pays the freight. Nothing like this. Both of them CFR, cost and freight. The seller pays the freight over here, right? In both CIF also and CFR also. CFR no insurance, and CIF shipper pays the insurance, means seller. Now this is right. CFR no insurance, and CIF seller pays the insurance, shipper. Okay, exporter. CFR shipper takes the risk. CIF consignee takes. It's not that. Consignee means buyer. Buyer takes the risk. No one. Here shipper takes the risk. CFR. Welcome to Adda 24/7. We are in the Sankalpa series for BFM. In this, we are covering various numericals, objective questions, case studies, okay, and theory questions as well. So follow this series completely. It is available in the playlist in the Officers Adda 24/7 YouTube channel. Subscribe to this channel. So let's move on immediately. Okay. Today I'll be covering different yield curves, types of yield curves. Okay. And then the questions on that. Very important part from your exam perspective. Yield curve. There are four types of yield curves. Always remember. Yield curves. One is this normal yield curve. Normal. Normal means what? Let me explain you this. Suppose if you keep a FD. Let's think of FD only. FD. You keep a FD of 3 months. 3 months. Okay. And then I keep an FD. Let's say me. I keep an FD for let's say 8 years. Okay. 8 years. FD is what is maximum FD available up to 10 years. Okay. In banking. So I keep you keep the FD for 3 months and I keep the FD for 8 years. So if you are getting the FD rate of interest of let's say 3.5%. Okay, you are getting an FD rate of 3.5%. What do you think I should get this rate of interest? Should it be more than 3.5? I'll write it more than 3.5 or equal to 3.5 or less than 3.5. Less than 3.5. Okay. So what should I get? What do you think? More than, equal to, or less than? I'm keeping it for 8 years, and here I'm keeping for 3. You are keeping for 3 months. So I'll be getting it for more than 3.5. Correct. I'll be getting more. Why? Because I'm keeping the money for the higher period. Okay, larger period. Right. So this depends on what? Keynes theory. Remember, Keynes theory is there. It says that the more you part with your money, the more are the returns expected. Now look at this curve. This is the maturity period and this is the yield. So this is 3 months over here and this is 10 years over here or 8 years over here. So that's why if you look at it, the rate of interest over here is higher. The rate of interest over here is lower. Now apply the same logic to bonds. Bonds with the lower maturity will have lower interest. Bonds with the higher maturity will have higher interest. This is a normal yield curve. Now this is possible when here we assume something. What do we assume? We assume that the country will grow upwards. Getting this point? If my country is growing upwards, only then this is possible. If my country is going into recession, then it will be exactly reverse. The FD rate, the bond rate for 3 months will be higher and bond rate for 10 years will be lower. This is known as inverted yield curve. Inverted yield curve is a sign of recession and normal yield curve is a sign of good growth. India is presently over here. Many of the Western countries, including USA and UK, they are in this phase right now. They are going towards this. Okay, they are artificially keeping the economy running over here. Artificially right now. We won't go into those details because it's a huge topic. Remember, just if anybody wants to check, just check the yield curves for USA and UK in last year from June 22 to December 22. And then you'll understand everything. Right now they are in this phase, going in this phase, recession phase. That's why their yield curves are slightly inverted. They have kept it going right now. They have kept it around this flat or to the other extent to this upper level, but they can hardly sustain for some time. 1 year, 2 year, 3 year, that's it. Okay, now what is this flat yield curve? Flat yield curve means country is not growing at all, not going down, not going up. Flat. 3 months rate of interest will be same as that of the 10 years rate of interest. Humped yield curve. This is called as humped. Humped means what? There is a slight growth in the initial period, but later again recession. So this is known as transition. Okay, transition means what? It grows in the initial years and then it transits to the lower growth phase. So recession phase. Here it is recession, here it is growth. So these are the 4 yield curves. In exam, mostly they will be asking you 1, 2, 3. Because this is transition, recession. Generally, this recession is asked more. Because why? This is only the typical one which is followed throughout the world. Okay. Now let's move on to the questions. When the upward sloping yield curve will appear, means when an upward sloping yield curve will appear, means upward means just now we saw this one. When will this appear? During the times of expansion, when recession occurs, during economic transition, when long-term interest rates are lower than the short-term interest rates. Long-term are lower than short-term. So when will this occur? In the comment section. I want it in the comment section. A, B, C or D. It is during the times of expansion. A. Okay. Now tell me in B, C and D. Okay, B, C and D. There are two options. Now look at this question. There are two options which are same. In B, C and D, there are two options which are same. Now, which are those options which are same? B is what? Recession occurs. B means recession. C means economic transition. So this will be what? Humped curve, camel humped, right? This is this camel humped curve. It will be like this. Okay, this just now we saw this. What is D? Long-term interest rates are lower than the short-term interest rates. Means what? See this. Long-term is lower, short-term is higher. So it will be like this. Now if this is like this, then what is recession? Recession is also the same. That's why B equals to D over here. Okay? It just I got it. The thought got into my mind. That's why I asked you. Okay? So upward sloping yield curve in the expansion, and recession means long-term interest rates are lower than the short-term interest rates. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CAIIB, we get it over here. Okay. Define the flat yield curve. Flat means, just now we saw that short-term bond rates are equal to long-term interest rates. Okay, so basically short-term rates equal to long-term. I think that is the answer or no? Let's see. Short-term interest rates are greater than the long-term. Short-term greater than long-term. So can you plot these curves? Okay, let me plot these curves. See this. Short-term equals to long-term. So this is flat over here. B1. Let's plot this B. Okay. Short-term are greater than. So short-term greater, long-term lesser. So it will be like this. Recession. Long-term interest rates are greater than short-term interest rates. So this C will be long-term greater than short-term. So it will be like this. Normal. Small companies provide greater yields than large company stocks. This has no base at all. There is nothing called a small company providing higher yields or higher returns. What is the yield? Yield means asking rate. Asking. Always remember, demand, rate in demand is yield curve. So it's nothing like this. Okay. So the answer is A. Okay. How do you define economic transition? Transition means that camel humped curve. Okay. Transition in an economy from recession to expansion. Okay. Transition in the economy from expansion to recession. None of the above two answers are correct and both are correct. What is this? Recession to expansion. Here, A. Let's plot this curve of A. Recession to expansion. Recession means it will be first like this. Recession means inverted curve, right? To expansion. So it will be like this. So what is this? Again, it is a hump. Look at this. It is hump somewhere. Okay. So this is also true. From expansion to transition B1. Let's plot this B. So expansion to recession. So this is also true. So both are transition curves only. So both the answers are correct. Okay. Now how to join this Officers Adda 24/7 YouTube channel? Well, for joining this channel, scan the QR codes. This blue is for Telegram. Black is for your YouTube. Click on scan this. Okay. Then this one is for the Instagram. And how to join the Instagram, this YouTube using these codes. And there is a separate channel on WhatsApp. So you can join this WhatsApp channel also. Just type Officers Adda 24/7 on WhatsApp. You'll get it. Okay. On WhatsApp channels now. There is a separate option of channels. Okay. A yield curve that shows downsloped curve is what type of curve? Downsloped. Now this is easy, huh? Normal yield curve, flat yield curve, inverted. All yield curves show down sloped curve. Is this all yield curves show down sloped curve? What do you think? The answer is normal, flat, inverted, down slope, down, down. It will be inverted. Okay, inverted yield curve will show down sloped curve. A yield curve that shows upward direction and which long maturity bonds have higher yields is known as. So if any yield curve is showing upward direction and long term bonds are having higher yield, just now we saw it, isn't it? What is the answer? A, B, C, or D? Type it in the comment section. Correct? Normal. Okay. Which of the following statements is false? A forward exchange rate is a good predictor of the future spot market. What is this? Forward exchange rate is a good predictor of the future spot market. Future. So forward rate is can predict the future spot exchange rate. Predict. Okay. A forward exchange rate and a future spot market may not be the same. So forward exchange rate and future spot market may not be the same. Okay. A forward exchange rate is an unbiased predictor of the future exchange rate. So forward exchange rate is an unbiased predictor of the future exchange rate. Okay. The spot exchange rate is a good predictor of the future exchange rate. The spot is a good predictor of the future. So we want what is false. What do you think is a false answer? Firstly, you should know what is true answer. Remember, nothing is over here in this question. It's just forward and future. Forward exchange rate is booked today for 2 months later. Okay. And future spot rate is the actual rate 2 months later. So that is basically the future spot rates. Here, just I'll explain you in simple terms. Today is what? Let's say any date. Okay. Let's consider 1st January. Okay. Jan 1, let's say. Today Jan 1. Okay. Now I book a rate today for dollar. And I book it for, let's say, March 1. I book the rate for March 1. Okay. So now understand what is forward exchange rate and what is future spot exchange. When I say forward exchange rate, I book this rate today for March. So this is known as forward because I have booked it today. Okay. Forward exchange. So this is forward exchange. Now what is future spot exchange? It means that actual rate on March. Actual here, if I book this rate today for March, let's say at 80 rupees 75 paise. Okay, if I booked it at 80.75, but actually on this date it goes to, let's say, 83 rupees. So this is known as my actual future spot exchange, and this rate which I book it today for the future is known as forward exchange. Now remaining things you can definitely get it. Okay. Future spot, same thing. Forward exchange, same thing. So which is the false one? Where is the answer? I didn't get the answer. Let's call this A, B, C, D. A, B, C and D. What is the answer? We want false answer. It is D. D is false answer. Spot cannot predict future. Only forward exchange rate can predict future. Okay. The objectives of central bank include. What is the central bank? Central bank means not Central Bank of India. It is RBI. We are having a separate bank called as CBI, Central Bank of India. Okay. So the objectives of RBI include to ensure country's balance of payments remains in equilibrium, to accumulate the country's foreign exchange reserves, to ensure the implementation of country's exchange rate policies, to control international trade. What should be the answer? RBI's main role is what? Ensure country's balance of payment is in equilibrium. Accumulate foreign exchange reserves. Accumulate means go on accumulating the dollars. To ensure implementation of country's exchange rate policy. Okay, implementation of country's exchange rate policy, and to control international trade. See here, nobody can control international trade. That's out. Accumulate is out. Now the question is only between A and C. Ensure country's balance of payments is in equilibrium, or ensure that implementation of country's exchange rate policy. See, this implementation depends on individual banks. whatever policy is there, that is done by individual banks. Okay, that is not done by RBI. RBI gives the policies. So the answer is A. To ensure that country's balance of payment remains in equilibrium. Subscribe to Officers Adda 24/7 YouTube channel. Just now I told you how to subscribe to it. You can subscribe it on the YouTube also. You can scan the QR codes, okay, and do it. Because you will be getting various free YouTube series, all these. Right now you are watching the free YouTube series. You get it over here, okay. The exporter should necessarily submit the export documents to the bank within 15 days from the date of documents, 15 days from the date of shipment, 21 days from the date of documents, 21 days from the date of shipment. Now what is the answer? Let me see how many of you can answer this. Yeah. 15 days from the date of documents, 15 days from the date of shipment. Okay, from the date of, what do you mean the shipment date? Shipment. What is the shipment date? Shipment date means whenever you get that bill of lading, on that there is a stamp called as shipped on board. Shipped on board. On board. Okay. This shipped on board stamp, whenever, whatever date it has, that is known as the date of shipment. So this exporter has to submit the documents to the bank. It's not, actual word is not bank. It is called as AD, authorized dealer. Okay. So the exporter has to submit the documents to the AD within 21 days from the date of shipment. Remember, 21, and these days are calendar days. Remember, 21 calendar days. There are 2 days in banking. One is calendar, second is banking days. Banking, whenever banks are open. Okay. The multinational company encounters the following exposures to foreign risk. So any MNC will encounter which type of risk? Translation, economic, transaction, and all of the above. What is each risk? What is translation risk? Translation risk means what? Suppose if I am, let's say, SBI. Okay. Is SBI a multinational company? Type yes in the comment section. Is SBI a multinational company? It is fine, because multinational means which has the branches or offices in more than one country. So SBI has various branches in outside also. Okay. So let's say SBI is having a USA branch, and this USA branch is having some profit. Let's say $1 lakh. It has a profit. Okay. $1 lakh. Now this $1 lakh has to be brought to India, not physically. Whenever on 31st March, SBI has to report its balance sheet to RBI. So while reporting it, it will also report the balances or the profits of its subsidiaries which are in foreign. But those will be reported in rupees, because RBI follows rupee system. So this dollar will be converted to rupees notionally. That is known as translation exposure. Whenever I convert this notionally, whatever notional profit I have or loss I have is known as the translation exposure. Economic exposure means basically economics related to financial. Transaction exposure means related to transaction, settlement. Mainly this will be settlement exposure. Okay. So any MNC will see what type of exposures, all of these, isn't it? The role of hedging agent is, means what is hedging actually? What do you mean by hedging? Anyone? Type in the comment section, what is hedging? Hedging means, yeah. Hedge. Buy in one market and sell in another. Suppose let's say there is a Reliance share. Reliance. Okay. And in NSE, let's say it's running at 2,500. And in BSE, it is running at 2,503. Now this change happens only for 3 to 4 seconds. 4 seconds only, not more than that. So within these 4 seconds, the whole game is played. So I'll buy 1 lakh shares over here and sell 1 lakh shares over here. Sell. Here I buy. What does this mean? I'll do it in 4 seconds. Buy here, sell here. So I earned 3 lakhs over here in 4 seconds. But what is the risk? If I delay in this, I'm gone, because this will automatically catch up with each other. So what is the role of hedging? Forget this agent. What is the role of hedging? Assist the firm in determining which foreign exchange transactions should be hedged. So here, depends on which currency or which commodity you are hedging. There should be enough liquidity in that. Liquidity. If there is no liquidity, then there's no logic of hedging. Hedging is always done in liquid stocks, liquid commodities. So which is to be hedged? So that should be decided. That should be supported by the team. Whichever agent's team is there, it should support that. A. Assist the firm in determining the types of currencies or interest rate swaps. So how should I hedge it? Here, what is to be hedged? First question is what? What is to be hedged? And second is how. So any hedging agent's job is answering these two questions, what and how. Okay. So answer is what? Over here. Answer is C, both A and B, isn't it? So friends, before going, the new Power Pack combo revision combo batch will be starting, okay, on November 1st. So join it fast. Okay. All the 4 subjects are covered. ABM, BFM, ABFM, BRBL, numericals, objective questions, everything. Revision batch. Okay. Fast batch. So join it fast. Also, you can join the Mahapack. In the Mahapack, you will be getting the multiple batches, plus ebooks, plus tests, everything. How to join the Mahapack? Let me show you. See here, go to Adda 24/7. In fact, I would suggest you to go through the app. Okay, in the app, you are getting the coin systems. Coin systems means that will give you around 1% extra. Okay, go to Adda 24/7. Look at this. Okay, come, click on JIB and CAIIB. On the front page itself, click on CAIIB November 23. See here, now we are in November right now, November exam. So click on this. You'll see this Power Pack revision combo batch. Click on this combo batch, English one. Then you'll see the details. See, what are the fees? 77% off, 2644. Huge discount is going on. And what all do you get? You get test series, ebooks, online live classes. Click on these ebooks. See, all the subject-wise ebooks are available. Click on this subject. You're getting chapter-wise ebooks for each subject. Okay. Similarly, you can go for the same and check for this test series also. Subject-wise. Okay. Click on this. And then you get again mock 1, mock 2, module-wise. Okay. So that's why join it fast. And what is the fees? This fees is what? Hardly 2644.77. Discounted offer. So join fast. OCT77. Apply this code. Click on buy now. Okay. See, this code is already applied over here. Else, if not applied, you can apply it. Click on apply and then go on. Okay. Click on continue. Fill in the details. That's it. Similarly, you can join the Mahapack as well. In Mahapack, as I told you, you get multiple batches. Look at this. CAIIB Mahapack. You get multiple batches. Similarly, e-video, ebooks, videos, test series, online classes. Mahapack you are having for various maturities. 3 tenures, 3 months. The fees is very less, 57449. 9 months, 8472. 12 months, 11861. And all of them are having 77% off. So join it as well. Okay. I'll be back tomorrow with another series. Till then, keep studying and do join the batches as well. Okay. So now, guys, the exam.